it allows you to actually own something, right? Nothing in this universe you can really own apart from your body, your mind, and now Bitcoin, can't be seized if it's sitting in your head, right? And so it really enables actual ownership over your property, A, and B, it offers this hedge from monetary debasement that has sort of plagued humanity for several decades now, particularly with the U.S. dollar and the U.S. dollar system, and obviously it's much worse elsewhere.
Hey everybody, welcome back to the Blockware Intelligence Podcast. This week I have on back again Joe Consorti. Joe, welcome.
Thank you for having me back on, Joe. We might break the space-time continuum with two Joes on the same show, but we'll give it a shot.
Yes, yet again. I think this is maybe your third episode with Blockware at this point.
Yes. Yeah, I came on at some point I came on twice last year, and then I came on, I don't know what we talked about the first time. The second time we talked about the whole FTX debacle and the speculative thing.
Yep.
Yeah.
Yeah, exactly. So let's just go ahead and jump right into it. Kind of on that note, is Binance on the cusp of being FTX 2.0?
That's a great question. Binance is an extremely shady business. I don't think I'm, telling any tales out of school when I say that. It's an extremely old-timey expression. I don't know why I chose to use that one. But I think it's really no secret that Binance is a very shady business. If you look up where they're incorporated, you find several different answers, right? They were a company that was founded in China, and then they moved to Japan in 2017. And now supposedly they're in Malta, Europe, in several other different places. And really, it's difficult to find out where they're incorporated. And so as a customer, you really have no idea what sort of deposit insurance at the government level is protecting you, if any. In terms of, deposit insurance, making sure that what you deposit on a platform can actually be backed if that platform goes kaput. The gold standard is really FDIC insurance. And, basically no crypto, no Bitcoin platform actually has FDIC insurance for your Bitcoin, crypto, whatever, because of the risks associated with it and the fact that Bitcoin is yet to be really incorporated to the regulatory purview. But Binance specifically, it has none. It's extremely opaque. And so any money that is on Binance, it's really up for debate whether or not it's yours. And in the eyes of the law, it isn't, right? You have no protection if Binance, the exchange, goes insolvent, goes under for whatever reason. And we also have no idea where it's incorporated, right? So it's not, you don't have FDIC insurance, any of these things. There are actually several lawsuits going on right now. I don't know if it's with Binance or somebody else, where they claim that they had FDIC insurance on their deposits, and they don't. And so it's really amazing what consumers think the level of safety is with these platforms, because it is much, much lower than has been assumed historically. And thankfully, over the last year, consumers have really learned that the hard way. And thankfully for myself, right, I had no money on any of these institutions. I think any sovereign-minded person or individual with 4 brain cells to rub together and understands what Bitcoin is and why it was created understands the importance of taking your money off all these exchanges. But really, Binance has been, not only do we not know where they're incorporated, they don't have any deposit insurance, but frankly, their founder has been engaging in really, really odd behavior on Twitter. Again, that's no secret to anybody. He constantly is posting photos of himself holding up the number 4, and then he captions it 4. I don't know what that's about. And then very, very frequently, the phrase has been funds are SAFU, S-A-F-U. I don't know what that's about either, but that's been going on for several years now. That's a thing that's been happening since 2016, 2017, when Binance was first launched. Funds are SAFU. And they really sort of project strength outwardly. They tweet very frequently, funds are SAFU. They have something called a SAFU vault or a SAFU account that is essentially this emergency fund that they're filling up with reserves. I don't know, past some mark. I believe it's in the eight figure territory now, but or actually 9 or 10 figures now. But even still, why would a company like Binance, and Binance actually claims it doesn't have any liabilities, which is an extremely silly thing to say publicly, and they've said it repeatedly publicly. So but Binance is basically projecting that it has no loans outstanding, it's never lent any money to any counterparty. Then why on earth would you need an emergency fund, right? Why would you need to be creating an emergency backup fund to ensure that customers can easily redeem their deposits unless their deposits weren't with you? So that was the question. And as it turns out, It's because Binance was rehypothecating customer collateral, right? When a user deposits money with Binance, Binance has their money, and the assumption is that Binance is holding that one-to-one. But that wasn't the case. As it turns out, Binance was lending out one of its own stablecoins that it created, BUSD, and essentially was lending several billion of it out. I believe the figure was 1.85 billion to various counterparties over the course of last year. And I'll send you this chart when you're editing so we can splice this in. But in the month of May, in late May, Binance basically emptied all of its BUSD token, which is the token that it created, when there were still $1.85 billion worth of customer deposits on the platform. That 1.8 billion of BUSD was off the platform, and it was lent to other counterparties and then slowly reaccumulated over the course of the next several months and replenished by August. But the question remains, for a period of time, Binance was lending out money, despite it saying on several occasions that it has no loans, never takes on any leverage, funds are safe. And so you have an exchange, you don't know where it's incorporated, there's no deposit insurance, it's clearly engaging in this solicitous behavior. And there's really no way of trusting this institution on any level, right? They're tweeting out very frequently, trying to project strength. They're saying they have no leverage. And clearly, we've discovered that this isn't the case. So just as every other exchange throughout 2022 that collapsed was very, very sketchy and showing sort of signs that it may not be the most healthy exchange in the universe, that's exactly what's happening with Binance now. Now, we don't know the scale of these operations. This could have been a one-time thing. I highly doubt it. This could be occurring with a slew of other Binance tokens. We really have no idea. But at the end of the day, you always want to have a very healthy level of skepticism. And this behavior, you can assume they've been doing for quite some time and in other areas. I believe that's a safe assumption to make. And if that assumption turns out to be true, you probably don't want to have any money whatsoever on the Binance platform.
Yeah, I mean, I think Binance, FTX, and others is kind of showing like a testament to how new this industry really is. Like, people thought FTX was like a very reputable brand. It had a lot of big names backing it. It was a relatively large company. Like, they grew really fast and had a lot of Bitcoin, or a lot of crypto at least, and then obviously completely imploded. And it's like, just because these platforms or companies have, many clients or many customers, and like it's a global brand, I mean, it shouldn't be too surprising, I guess, or you should still be extremely cautious that, hey, like, this is a startup. It's just a really big startup, and like, when you grow that fast without like much regulatory like overview and oversight, I mean, things could go really bad.
And virtually
really
no regulatory oversight at all.
Yeah.
There is none. And also, people, there's this illusion of safety that comes with the size. If, FTX has, we just reached 50 million clients, 100 million clients, 200 million global clients, jump on board. There's this illusion of safety because we historically associate financial institutions with domestic banks in the United States that have deposit insurance. If everybody runs to the bank and tries to get their money out, rest assured you'll be able to withdraw all of it. But that's not the case for these big crypto institutions, but they've been sort of leveraging that human belief, that psychological belief that we tend to fall into, that, a lot of people are doing it, therefore it's safe, when it couldn't be further from the truth.
Yeah, kind of going off that idea of, okay, custodians and self-custody. Do you think more and more people will learn to self-custody, especially if something goes wrong with Binance? And then also, do you think custodians will become more responsible and maybe more transparent?
I certainly hope so. I think the logical outcome of any event where you have a custodian that goes belly up is many people on the sidelines, they learn that, wow, self-custody is important if I have any money on any of these exchanges, right? Even if it's a Bitcoin-only exchange, which ostensibly is much more safe, much more robust, then the people on the sidelines learn, I better get my money off of my exchange. And so you'd hope that that's the natural thing people learn. if you observe on-chain data, that pretty much clearly is an outcome that is occurring when people witness these things. Volumes of Bitcoin tend to move very, very quickly off these exchanges, Binance included. And for some of the shakier players that threatens their solvency, I'll quote my friend Dylan LeClaire, our mutual friend Dylan LeClaire, when he says that if an exchange is solvent, it'll be able to meet all withdrawals. And so when it comes to solvency, there's no such thing as FUD, right? Allow all of the withdrawals to commence, literally drain all of the reserves down to zero. And if the exchange is still solvent, that shows that they're a robust exchange. But at this point in time, you really don't know who's lying and who's being truthful. So the natural outcome of this, as you can observe on chain, these Bitcoin are flowing away from known exchange wallets and away, presumably, into personal cold storage. And unfortunately, as I was talking about people on the sidelines, but unfortunately, some people learn the hard way. Some people have money on these platforms and it just disappears overnight, completely gone. And that's a really unfortunate aspect of these things. And as we know, in the case of Mt. Gox, which is still underway and getting settled, the theft of all of that Bitcoin is still, sort of being litigated. And so these things can take several years, even decades to sort out. And especially for platforms like FTX, chances are you're not going to see your money ever again. You might see a fraction of it with whatever remaining assets they're able to liquidate it. But really, self-custody is extremely important. And thankfully, there are more and more intuitive, user-friendly self-custody solutions that are coming to market. I know Foundation Devices is a sponsor of your show, and we're good friends of them as well. So devices like the Passport, easily the most user-friendly wallet that is on the market, right? If you know how to, there you go, right there. If you know how to operate a cell phone, then you know how to operate a Passport. And so really user-friendly devices such as what Foundation has created with the Passport, use code Blockware for $10 off, I believe, is pretty remarkable. And it's the main hurdle that comes with self-custody is just normal everyday people getting to use it. Because when you hear cold storage, when you hear these terms, some people get, no pun intended, but they get cold feet, right? They hear all of it. They don't want to have anything to do with cold storage, all of that. It just seems super confusing. But if you have a mobile wallet, that's better than being on an exchange. Obviously it's a hot wallet, so you're still susceptible to theft of that should somebody be able to unlock your phone and transfer those funds. But it's a step in the right direction. And as more user-friendly alternatives are coming to market, then the more and more self-custody will become a thing, and the less these exchanges will be able to scam consumers by rehypothecating their money. Because I believe that through time, obviously people will continue keeping their Bitcoin on exchanges. And in order to, minimize the risk of that being rehypothecated and moved off the platform, that has to come with regulation, right? Bitcoin institutions need to be folded into the regulatory purview. If the SEC is serious about protecting consumers, then it should probably get up on its horse and start taking Bitcoin custody seriously and making sure that these institutions are properly regulated so that consumers are protected. I think that's one natural outcome of this. I think the other natural outcome is that people are going to shift towards these cold storage solutions, towards these hot wallets as they become easier to use. And Foundation is a perfect example of that. And this is happening in real time. This is observable through coins flowing off of exchanges on chain.
Yeah, absolutely. Shout out to Foundation. You can definitely click our link below in the video or in the pinned comments.
That was one hell of a plug, huh?
That was great, yeah. But no, I think you made a really interesting point. I've heard executives at River and Kraken say, we don't actually want to be holding your Bitcoin per se, right? Like we, sell Bitcoin and we help you buy Bitcoin, but we don't want to be holding it because we don't make any money off of that. So it's like, if an exchange is like encouraging you to like not withdraw or like limiting withdrawals, that's like a major red flag.
Yep. Binance, right? They're saying funds are safe. Don't worry. Versus an exchange, exactly like you mentioned, Kraken. Obviously they have other cryptos on their platform, but they have Bitcoin and they encourage you to withdraw. River, the guys over at River are fantastic. Their CEO is constantly tweeting about self-sovereignty, self-custody. They have tutorials on their website about how to get the coins off, right? You can buy with us and then take it off our platform immediately. Even though River, I know, has a very, very robust cold cold storage solution for all consumer funds. And it's really, those are the exchanges you can trust versus the exchanges that say, don't worry, it's all FUD, funds are safe. If funds were safe, exchanges like Binance would be encouraging users to take them off the platform. Like you said, it's a huge red flag for sure.
Yeah, absolutely. Let's go to some audience questions that we had. So I think before this episode, we posted on Twitter, we're like, hey, we're having Joe Consorti back on. Does anybody have any questions for him? So we got 3 really solid questions that I think are worth asking. The first one is talking about the Lightning Network reference rate that you and Nick worked really hard on, or Nick at least started the idea of multiple years ago. This audience guy asked a question. He said, okay, the Lightning Network reference rate is a cool concept, but it seems highly doubtful routing is ever profitable or deep enough to truly serve as a global risk-free rate of return. So maybe, I guess you can explain high level, like what even is the Lightning Network reference rate, and then answer the guy's question.
For sure. So I'll explain what LNRR is, and then I'll sort of explain what makes a rate risk-free. And what the current suite of risk-free rates is, how Bitcoin could get there. I'm excited for this question. At the Bitcoin layer, the sweatshirt that I'm wearing, the logo you see on the back, and the big neon sign you see behind me, we have a primary focus in 2 things, and those are that's rates in global macro more broadly in Bitcoin. And so we try to integrate those 2 together as much as possible. And one of the first pieces that my colleague Nick Bhatia wrote about Bitcoin was about this thing called the Lightning Network reference rate. The idea is because individuals can use the Lightning Network to deploy capital and then earn a rate of return by routing transactions, then you could derive an interest rate from that, right? If there were a consensus method of calculating an interest rate based off of fee metrics observable to everyone on the Lightning Network that were self-submitted by Lightning nodes, then you could ostensibly create an interest rate that was derived from Bitcoin, a Bitcoin-derived interest rate. And it was an extremely interesting concept back then, and it's still just as interesting now. Several people are developing methods of actually calculating this and displaying it on their websites. And we're in talks with several of those people right now to actually construct a Lightning Network derived yield curve, which is a concept that Nick spoke about, and I wrote another piece on within, I believe we called the piece Time Value of Lightning Network, or the Time Value of Lightning Network, in which I sort of discussed that if a yield curve, with a reference rate that is derived using Lightning Network data, a rate of return that can be earned by efficiently allocating Bitcoin, then off the back of that, you could construct a yield curve, which is essentially the rate of return you could earn by deploying your Bitcoin on the Lightning Network for certain periods of time, right? If you deploy it for 10 days, you can expect to earn this amount. If you deploy it for a year, you can expect to earn this amount. And the longer you deploy it for, you have this positively upward sloping curve. Now, what does a yield curve do? It attracts capital allocators. If you regularly publish a yield curve that shows, hey, if I learn how to efficiently route transactions more so than the guy next to me, if I can effectively manage these channels really well, then I could earn a very, very solid rate of return. And look at this yield curve through time. These are extremely competitive rates. I have the technical wherewithal to spin up a Lightning node and run channels. I'm going to go try this. And that's really, how you start a capital market. That's really how you can attract an extremely large swath of capital that may be waiting on the sidelines, because there is no way to sort of earn a rate of return that's native to the Bitcoin network itself. And through the Lightning Network, that's really what it provides. And several of these companies are now beginning to come up with methods of calculating that rate and displaying it publicly on their websites. And that's basically what the Lightning Network reference rate is. Now, back to the question of, it'll never be profitable. And so therefore Lightning Network reference rate can never be considered a risk-free rate per se. Risk-free rate obviously comes down to the the risk profile associated with the counterparty you're talking about. Currently, the risk-free rate is the suite of U.S. Treasuries. Along the U.S. Treasury curve, you could park your capital anywhere from 1 month all the way out to 30 years. And the reason that it's considered risk-free, namely the shorter tenors are considered risk-free because they incur a lower amount of interest rate risk, is because the U.S. Treasury has never actually defaulted, right? They defaulted obviously in the past a few times, right? In the 1910s and then in 1971, of course. But in terms of actually missing a payment, right? If you were a holder of a U.S. Treasury, they haven't nominally defaulted yet, and so that's essentially why it's considered the risk-free rate. It's the deepest and most liquid market for fixed income securities in the world, and because of that constant inflow of capital and demand for these instruments, then the counterparty associated with it as well, chances are they're not going to default, and so that's why the U.S. Treasury curve is considered risk-free. Now, what does Bitcoin need in order to sort of achieve that moniker of risk-free rate? Well, Bitcoin has no counterparty risk, right? The Lightning Network has no counterparty risk. And so already, even though the U.S. government has the lowest counterparty risk relative to any other fixed income issuer at the sovereign level, at the corporate level, all around the world, it still has counterparty risk, right? It has the lowest, that's why it's considered risk-free, but it still has counterparty risk. Bitcoin doesn't have any of that, right? There are other risks associated with deploying capital on the Lightning Network, early channel closure, inactive peer risks. There are a different suite of risks, but there is no counterparty risk. And granted, you could sort of interpret that as, okay, the Lightning Network is more risk-free than the suite of U.S. Treasuries. But then the question becomes, okay, if that's the case, why on earth would I go to the Lightning Network when it's still so illiquid, relatively speaking? If you go, I have the capacity of the Lightning Network in front of me. Even still, it's only got roughly 500 billion sats on the network. And so that is an extremely low amount of Satoshis and, a low amount of US dollars. It's growing every single day, but still it's relatively illiquid. And I'll agree with the commenter who asked that. It's going to take several trillion dollars more to be considered sort of a risk-free method of parking your capital, right? Safety sort of comes in liquidity when we're talking about fixed income markets, right? Because fixed income is used to lubricate global finance, right? You borrow against the U.S. Treasuries you have in your portfolio. You can't really borrow against a collateral type that's going to be extremely volatile, like your capital that's parked in the Lightning Network. Because there are only 500 billion Satoshis, right? That makes for a lot of collateral volatility. Therefore, it's not a very appealing collateral to borrow against. But through time, the capacity is clearly increasing, right? If you take a look, this time in 2019, there were only 100 billion sats in the Lightning Network. And as of right now, it still hasn't achieved the exponential growth profile of something like the Bitcoin price. But through time, cycle after cycle, as more tools get built on the Lightning Network, ostensibly it will. And so with that additional liquidity comes more safety. And with that safety comes an increased tendency of people looking at the Lightning Network, taking a look at, wow, that I can get I can charge a very, very good base fee, a great fee rate, and companies who have Lightning Network Explorers that regularly publish a Lightning Network yield curve, and also methods of companies that sort of automate a lot of this for you. Then that will attract more capital, more liquidity that's parking the Lightning Network, and that will bring it ostensibly to a more risk-free rate than the suite of U.S. Treasuries. And so that's, long-winded explanation about what makes a risk-free rate and why I agree with the commentary that it's not necessarily risk-free as of right now because it doesn't have the liquidity, but through time, as its liquidity amplifies, as it reaches $1 trillion, and then potentially even, the U.S. Treasury market is $20 trillion in size. As it comes closer to that, it's going to be seen more as an alternative and less so sort of an experimental market.
Yeah, I definitely agree. It's certainly early days for the Lightning Network. I personally run a Lightning node, and I earn sats with channels that I've opened. However, on net, I think even opening my channels with 1 sat per virtual byte, which is the cheapest you can open a channel for, I've still lost money. But I have seen people that are actually running Lightning routing nodes, they actually are earning decent yields right now. Obviously, it takes a lot of time to do that, and the network is still like very small, and there's not that many transactions on it yet. But I think it's definitely already working right now, and like some people are actually earning a decent yield. It's just hard. Like I've spent a decent amount of time on it, and I don't know how to like set up channels in the exact right way where I know that there's going to be traffic through those channels that I can route and charge like a pretty high fee for.
Exactly. So. And similar to sort of the early days of Bitcoin, it just comes down to who can do this the most efficiently. And as more people do it efficiently, there's going to be increased demand for innovation. There's going to be more thought. There's going to be more intellectual capital, obviously human capital as well as physical capital that flows into the space and figures out how do we do this efficiently. Pretty soon, a decade, 2 decades from now, you're going to have people that specialize in Lightning liquidity management. That's going to be a position. And frankly, it's probably going to be offered at some of the biggest banks in the United States and the world, should they decide to begin onboarding to this new technology. If the Lightning Network was becoming less viable as a method of doing this, if it was moving further away from being a risk-free rate, then you wouldn't see the fee rate continue going up, right? You wouldn't see, demand for you wouldn't see channels continue going up as they are. You wouldn't see the base fee and fee rate going up as they are. And so there's rising demand for these vehicles, and with that rising demand comes more people who are willing to, sort of go to California to try to mine the gold, right? So, as of right now, obviously we're deep in and amidst the bear market, but demand for these instruments is still relatively steady, and you can bet that once Bitcoin price sort of reignites again, then that growth is going to amplify too.
Exactly. I've said before that I think Bitcoin has scaling cycles. Like we obviously have price cycles, but we also have scaling cycles. And, over the last 12 months or so, blocks, for the most part, other than this small ordinal section that we had, for the most part, blocks on the Bitcoin network have been, not empty, but not full, to where it's pretty easy to send Bitcoin over the Bitcoin network on the base layer and not pay a very high fee. But I think when we do go, kind of to your point, when we do go into another massive bull market, that's going to, bring fee pressure up as people like demand final settlement in Bitcoin. And when fee pressure rises, people are going to be incentivized to use other scaling solutions like the Lightning Network. And then when all of a sudden you have 10x or 100x more transaction volume on Lightning, that's when routing is probably going to get even more profitable.
100%. And because you mentioned the mempool, what way do you observe mempool.space? Do you observe it new blocks coming in from the left or new blocks being appended on the right?
It's a great question. I don't know. I guess I do the default. I don't even know which one it is. What do you do?
You didn't know that you could flip it one way or the other? This is a huge controversy.
I've seen the debate of flipping it, but I don't know. I use the default. What do you use?
I use the American way of doing it. New blocks are the default is new blocks get appended on the left, but Gigi made the argument that we Americans, right? We read left to right. Time moves from left to right. All of those different arguments that Gigi somehow has the ability to make. And he got the developers of mempool.space the ability to actually switch it around. And so I see new blocks coming in on the right, like a true American should, Joe.
I'll have to look for that setting and try to flip mine and see which one I like best. But I've definitely seen the debate. Let's go to the next audience question. So this was actually from the same guy. He said, have you and Nick, so Joe and Nick, have you guys looked into Bitcoin-backed stablecoins, which kind of resemble what Nick laid out in his book, Layered Money?
Yeah. So there are several cool things going on when it comes to Bitcoin-backed stablecoins. We saw early last year the calamity that can ensue with algorithmic stablecoins and crypto-backed stablecoins. Several of those died really early on, and they tend to have really, really violent unwinds. And what people thought was a safe and easy way of holding your dollars on a blockchain turned out to be, nothing more than a Ponzi scheme or something that was extremely risky. And something like StableSats, which is by Galoy, which allows you to transact dollars over Lightning, no stable coins, no fiat integration. It essentially allows you, and currently it's in beta testing. It's available on the Bitcoin Beach wallet. Essentially, you can send and receive dollars within your Lightning wallet. So that's very cool. That's an instance of sort of the US dollar being interoperable, not necessarily a Bitcoin-backed stablecoin, but a stablecoin, a US dollar equivalent, we'll call it, that runs atop Bitcoin Lightning. And obviously the development of things like Taro, which will allow users to create assets and then send and receive those assets. Now, obviously, there's been debate about that, but what that will ostensibly allow for is for, obviously there's a level of trust that goes along with this, unfortunately. But that's the case of the U.S. dollar, whether it's issued by whether it's issued by the Treasury rather, or it's issued by a trustworthy counterparty on Lightning. It's going to have to be issued by somebody. But Taro will allow you to issue assets over Lightning, and ostensibly there will be U.S. dollars. There will be U.S. dollar equivalents, stable coins, if you will, that are issued over Lightning. And so, as of right now, there aren't, at least I'm not aware of many Bitcoin-backed stablecoins that are, popular, highly liquid. But I do know that there's this emergence via StableSats and eventually via Taro, where U.S. dollars will eventually be able to be transacted over Bitcoin and Lightning.
Yeah, it's definitely in very early space, and I'm excited to see how it develops. But yeah, there's nothing at this moment that's like completely taken off as far as like a Bitcoin-backed stablecoin. Kind of relating on to what you were just talking about, Taro assets, you talked about stablecoins. Do you envision like other assets getting used or getting like, I guess, created on Taro? I know this is an audience question. He was like asking, okay, will commodities or securities and debt be issued on Taro? I kind of have the view that like issuing physical items on a blockchain doesn't really make much sense. So like commodities, I'm not necessarily a fan. Really, most things on a blockchain don't really make much sense to me, but I guess I could see like how it's easy to trade, I don't know, like shares of certain Bitcoin private equity back and forth, maybe on Taro or something like that. But then again, that might just be like skirting security regulations. So what are your thoughts on like Taro and like what assets will be issued on it? And like, are you bullish on Taro, or generally, what do you think about Taro?
For sure. As of right now, I'm bullish on Taro purely because it's going to drive up demand for, efficient Lightning Network capital allocation, efficient channel management, and that's ultimately what I'm super bullish on, right? Anything that gets created, whether it's on Bitcoin, adjacent to Bitcoin, or on or adjacent to Lightning, ultimately I feel that so long as it's not disruptive of the actual use of those two things, I say the more the merrier, right? Because if these ideas are being created and it's not changing, it's not harming the way that Bitcoin's consensus mechanism, it's not harming the way that Bitcoin or Lightning functions, then I say the more the merrier, right? Because it ultimately drives up block space demand, it drives up demand for efficiently allocated channels, it drives up, driving up capacity on the Lightning Network. That just means that it gets even cheaper to transact Bitcoin. So, the idea of, use cases of crypto, that's obviously why you at Blockware are not crypto, you're Bitcoin. Us at the Bitcoin layer, we're not crypto, we're Bitcoin, because we recognize that the primary use case of something like Bitcoin is obviously as a hedge against monetary debasement, which has been the endless solution to all of the credit crunches that we've had over the many decades. And B, it allows you to actually own something, right? Nothing in this universe you can really own apart from your body, your mind, and now Bitcoin. Can't be seized if it's sitting in your head, right? And so it really enables actual ownership over your property, A, and B, it offers this hedge from monetary debasement that has sort of plagued humanity for several decades now, particularly with the U.S. dollar and the U.S. dollar system, and obviously it's much worse elsewhere. We recognize that's the use case of a currency as it pertains to a blockchain. That's what a blockchain is for. That is a blockchain's use case. There are no other use cases for it. It's nonsense to say, oh, well, it can solve. I've heard so many in the past, and you've heard so many in the past. It can solve the healthcare system. It can solve, it's for trading cards. It's for this. It's for that. But ultimately, it's really just that's nonsense, right? Saying that the blockchain is for anything else other than verifiable ownership over digital money is nonsense. It's foolish, and it's basically just been a way over the last several years now of companies, when they have no idea or they're a lackluster version of a normal company, to raise money and raise capital. They use they use blockchain, they use the word Web3, and really it's just a sort of a buzzword that means nothing. That's essentially what I view the other use cases when it comes to crypto as being. But with Bitcoin, it's very, very unique because any other use case that gets created still has to follow Bitcoin's consensus mechanism. And so in the case of something like Taproot, the Taproot wizards and all of the ordinal inscriptions that have come out, that is basically all it is. It's not disrupting the Bitcoin protocol itself. All it is sort of a social viewing layer, if you will, of sort of ordering Satoshis, ascribing a value to ascribing an integer to these Satoshis in order to view them a certain way. And that's all it is, right? It's basically, someone creating a magnifying glass and looking at something a certain way. It's not actually disrupting the Bitcoin protocol itself or the way that it functions. And I think that Taro assets will largely occur in the same way, right? You don't have to touch them if you don't want to. You don't have to send or receive them if you don't want to. If you're a Lightning Network operator, all it's going to do is give you more revenue because you can route them and you're not touching anything. It's just being routed via Satoshis. That's a beautiful thing. And so it drives up demand for uses on the Lightning Network, just like these ordinal inscriptions drive up demand for block space. And so really, I may not agree with the assets that get issued on Taro. If NFTs begin getting issued on Taro, or, if bonds begin getting issued on Taro for certain companies, if people are allowed to buy shares in certain Bitcoin companies on Taro. I may not necessarily agree with any of those use cases. I'm not saying I do or I don't, but at the end of the day, it's driving up demand for use of the Lightning Network. And so, frankly, I say the more the merrier.
Foundation is one of my favorite Bitcoin companies. Their product, Passport, is one of the best Bitcoin hardware wallets on the market. It is air-gapped and highly secure. I strongly encourage you to go to foundationdevices.com and use the code BLOCKWARE and get $10 off your Passport. It's a great way to easily and securely store the private keys to your Bitcoin.
Yeah, I think that's a very fair perspective for sure. Let's kind of dive into Operation Chokepoint. Can you kind of explain what that is to the audience that hasn't heard about it? And is it a problem for Bitcoin and Bitcoin companies, or even crypto companies too?
Yeah, for sure. So Operation Chokepoint 2.0 is coined by Nick Carter. And essentially, it's used to describe this recent regulatory crackdown on crypto institutions and whether it's their ability to operate, sort of going after them with securities law, or whether it's severing ties to traditional banking outlets. Essentially, the name of the game is to basically make it extremely difficult for Bitcoin and crypto companies to operate and sever their ties to banking partners so that there are no US dollar on-ramps, and they really have no ability to operate because of that, right? They can't accept user deposits, because of that. It makes it extremely hard if you don't have a banking partner that allows you to be interoperable with US dollars. And one of the biggest instances of this is JP Morgan today, and I tweeted about this. JP Morgan severed all ties with Gemini, and that was one of Gemini's biggest banking partners, and now it wants nothing to do with Gemini. It was one of its biggest banking partners, and the other big banking partner for Gemini was Silvergate, and now Silvergate is unfortunately going under, or at least it very much seems like it. Yields on Silvergate senior secured notes are soaring through the roof. That's getting sold off very, very quickly. Its stock price is down very tremendously, and so people are really betting on some kind of bankruptcy coming from Silvergate, and you're seeing them having a great deal of struggles. And they were one of the leading banks. They were the leading bank for Bitcoin and crypto, quote unquote, and so. Basically, it's severing these crypto firms, these Bitcoin firms' ability to operate as companies and regularly accept user deposits and operate as a business because they're getting cut off from U.S. dollars and dollar interoperability. And so, Silvergate had it serviced a lot of players that everyone knows about, right? Coinbase, Kraken, Gemini, Genesis, which is now, a whole nother story. They serviced, I believe, FTX. They serviced Circle. They serviced Binance, Paxos. All of these entities are serviced by a very select few number of banks that are willing to, do business with them. Silvergate was one of them. Prime Trust is another. Prime Trust does, I believe, I don't want to talk out of turn here, but I believe they do Swan's banking. I believe they're Swan's banking partner, and they are Strike's banking partner, right? And so, these banks that work with crypto institutions are now going under in the case of Silvergate, or severing ties entirely in the case of the more formal traditional finance, JP Morgan. And so it's really not good. And the idea of Operation Chokepoint is that this is basically the regulatory authorities within the United States taking everything that happened in 2022 very opportunistically and seeing it as an opportunity to finally crack down on this crypto fraud, these crypto scams that have really, really harmed consumers. And in the case of frauds and scams, that's actually a good thing. That's a great thing. But by the same token, these dollar on-ramps are the same ones that service good faith Bitcoin institutions that aren't trying to do anything scummy, right? Institutions, and again, I don't know who these people's banking partners are. I'm just giving examples of good faith Bitcoin institutions, like Swan Bitcoin, like River, like Strike. All of these institutions are literally saying, they say regularly, after you buy with us, take your coins off the exchange. That's a good entity by all accounts, right? A lot of these entities have gone to regulatory authorities and said, hey, can we have some more clarity here? We'd like to be folded into the window. Here's all the information about what we do, right? And they get bundled up with these scams. So from the standpoint of cracking down on crypto scams, right, Operation Chokepoint is a great thing. But from the standpoint of cracking down on good faith institutions that don't have any harmful predatory products, which tend to be Bitcoin only institutions, funnily enough, they're also being bundled in with those scams. So, we're taking the good with the bad. It's sort of, we're basically being forced to eat our vegetables, right? We've already eaten our vegetables, but alongside with these crypto institutions that are now, the regulatory authorities really hammering them, rightfully so, Bitcoin's being forced to eat its vegetables a second time, unfortunately. And it's just the unfortunate reality of being associated with crypto rather than being, thought of as two separate asset classes, which you and I both know that they should be.
Yeah, you touched on FDIC insurance and Silvergate. I've heard before that FDIC insurance insures basically 1% to 2% of demand deposits for I guess all U.S. banks. So in reality, there's not much actual insurance backing everyone's demand deposits. Even if, of course, if every bank failed, that would just be catastrophic. It would probably never get that bad because there would be bailouts anyways. But I wonder if Silvergate actually did fail or got close to failing, how much of a dent would that make in FDIC's, insurance fund, I guess, if they call it that? I don't even really know. And you may not have an answer to this, but curious, do you have any thoughts on that?
Yeah, so it certainly wouldn't have been good, right? If any bank fails, and they have FDIC insurance, and the user, the users of that bank, the people who have deposits with them, the FDIC has to pay those out. It's obviously a pretty big dent into what the FDIC pays out, and so it's not good. And so potentially, the idea of Operation Chokepoint 2.0 is that this is somewhat deliberate, right? This is somewhat a coordinated, deliberate crackdown. And what you're saying could be true. It could be, the simple fact that the FDIC is really seeing all of this risk boiling under the surface, and they don't want anything to do with it. And so not only are they, really disallowing these good faith Bitcoin institutions from coming into the regulatory window and becoming FDIC insured, but they're also taking a look at some of these institutions who they have afforded FDIC insurance and saying, let's make sure that these institutions go under now before they get much larger, and therefore they pose a much larger risk to us if they go insolvent and we have to pay them out. So you're right, it could be a savvy decision on behalf of these authorities who would be responsible in cleaning up the mess and saying, before this balloons out of control, let's take it out behind the shed and put a bullet in it. It could very well be that.
Yeah, it's interesting. I also imagine that Silvergate doesn't have JP Morgan probably has, millions and millions of small clients that all kind of each of their accounts adds up to the $250,000 FDIC limit. Whereas I could see Silvergate not having that many clients, but like each client has like millions and millions of dollars in their account. And so it's like FDIC really isn't covering, like it's not a big hit because there's just not that many clients that they have to pay out for the $250,000 minimum. But let's shift into macro a little bit. Interest rates really seem to keep going higher. How much higher do you guys think that they're going to go?
That's a great question. Really all this comes down to is how hot the economic data will continue being, and how much the Fed is willing to meet that economic data that's hot with a policy response that will take it back down to being cool again. And we know the answer to the second question. The answer is that the Fed is going to, every single hot economic data print that they find, they're going to meet it with, more hawkish rhetoric and tighter policy. And we've seen that at basically every turn. This week was no exception. Yesterday and today, it's basically been the Jerome Powell show. If you turn on your television, if you turn on Bloomberg TV, it's literally no market commentary whatsoever. It's just Congress grilling Jerome Powell. And we know that this cycle in particular, everything that Jerome Powell says, every economic data print has been held under a microscope. Markets are basically operating, they're operating on a dime at this point. Everything that the Fed says, every new economic data print, they're moving one way or the other. It's a highly volatile environment. And so in this environment, U.S. Treasury rates, again, as I mentioned earlier, the deepest, most liquid market in the world, they provide a whole lot of signal for where they believe inflation and growth expectations are headed, as well as where they believe policy rate expectations are headed. A lot of people don't know this, and I think Will did a good or reflexivity research. It could have been Fei Zhao, I'm not sure, but they did a tweet thread, I believe, about how, and we've been saying this for ages over at TBL, and thankfully I had the mentorship from Nick to teach me this a while back. But the Fed doesn't move interest rates up or down, right? When you hear the Fed set interest rates 50 basis points higher, it doesn't mean that the Fed cranked up U.S. Treasury rates. The Fed doesn't control U.S. Treasury rates, nor does it control the majority of other money market rates. What the Fed does is it uses Fed funds as a communication channel for where it would like front-end rates to be. And the way that it manages front-end rates is through its overnight reverse repo facility and through interest on reserve balances. Those are two rates that it sets as basically a floor and a ceiling for short-term interest rates. And it uses Fed funds as sort of this communication channel for where it would like those to be. And so basically what's happened is the suite of U.S. Treasury rates, which is set by the free market, they essentially move independently of the Fed. Sometimes they agree with where the Fed thinks rates should be, and sometimes they disagree. And heading into the year, they were largely in disagreement with the Fed, and they were saying that, look, we think growth and inflation is coming down. We think that you should probably pause soon, right? We see the terminal rate, i.e. the highest rate that the Fed achieves this cycle. That's relatively close. I think it would behoove you to pause soon. That's what the rates market was saying, because rates were falling. They were catching a bid basically all across the curve. People were comfortable parking their money for 4.5% and chilling. And now, throughout January and into February and now into March, time is really flying. We've seen hot economic data print after hot economic data print. And so the rates market has said, looks like growth and inflation expectations, we should edge those up a little bit. It looks like growth is a little bit more robust and inflation is a little bit stickier. And we've seen that sticky inflation and some of the components of inflation that are harder to shift, such as core PCE, core personal consumption expenditure, that has actually risen month on month, and it's risen on a year-on-year basis. That's not what the Fed wants. The components of that influence inflation the most are what people are spending. And if personal consumption expenditures are rising, then the Fed sees that as no bueno. And the rates market agrees. And so the longer end of the curve, let's say the 10-year, that yield is correspondent with growth and inflation expectations. And the 10-year yield started rising pretty materially. And in response, what is the Fed trying to do right now? They're trying to crack down on growth and inflation. And so what does the front end do in response? The front end also moves higher, because the front end is saying, hey, look, growth and inflation are really robust. The Fed's probably going to continue hiking, and they're going to continue hiking until they start to see these measures like core PCE move down. And so that's what we've seen all throughout January, all throughout February. That's why yields are ripping through the roof, because growth is much hotter than expected. We've had as these really, really hot economic data prints keep coming out within the labor market, within personal spending, those are things that the Fed wants to see turn down, not turn up. So growth and inflation is more robust than expected. And as such, in order to meet that, because inflation is elevated, the Fed's trying to kill inflation, then policy rate expectations are also rising. Within Fed funds futures, the terminal rate is now priced at 5.5%. 3 months ago, it was priced at 4.5%. 3 months before that, it was priced at 3%. Nobody thought that the Fed would be able to get this high because everybody was expecting, and this was what was priced in with inflation swaps. Everyone was expecting that inflation would be back to 2% by June or July. And that's not the case. People are finding that inflation is stickier than expected. Growth is stickier than expected, and therefore the Fed's policy response is going to have to be higher than expected. And as such, the rates market is now repricing upward. They're selling off very precipitously in order to sort of meet the Fed where they expect the Fed to be.
Yeah, well said. So I guess what does all of that mean for Bitcoin? I mean, 2022 is obviously a tough year for Bitcoin holders and Bitcoin miners. What is your outlook for the rest of 2023? It seems like the Fed is getting more aggressive, as you're saying. Does that mean Bitcoin could make new lows relative to their 2022 lows? Or what do you think's in store for Bitcoin for the rest of this year?
That's a great question. So it all revolves around liquidity at the end of the day. And although rates continue rising precipitously, right, the cost of capital is rising, and that's going to transmit to companies, and that's going to transmit to individuals and the rate at which they can borrow. And so the economy is eventually going to slow down, right? Eventually, these 5.5%, 6% rates are going to have to matter. And through 2022, we had this regime where Bitcoin was negatively correlated to rates. But traditionally speaking, risk assets and bonds have an inverse correlation, right? They don't have a positive correlation, as was the case last year. Last year, as bonds sold off and rates rose, right, bonds were getting sold off and risk assets were getting sold off. And that's not usually what you see. We've only had 3 other instances of that through time. I believe the years were 1929, some point in the 60s, I can't recall the year, in 2022. And every single time that that's happened, we've had a pretty bad depression a few years following it, a pretty huge, severe recession in the years following it. You don't usually see that bond equity correlation break down, or more broadly, that bond risk asset correlation broke down. That was the story in 2022, but now correlations seem to be shifting where the bond equity correlation is moving back into negative territory, which means as rates rise, it's actually not as bad for risk assets as it was last year. And so long as that correlation continues to hold, really elevated interest rates may not have a huge effect on equities and then other risk assets that trade like equities, such as Bitcoin. A lot of that, basically what happens when rates begin to rise, you see multiples compression first, right? So those price to earnings multiples that are trading at 20, 25, 30, Tesla, super overvalued stock, those get compressed down to more reasonable levels, right? 15 to 18. And then you also, so that's the first thing that happens when rates rise. It's the equity response. And then the second response is when the actual cost of capital becomes impacted by that, when companies need to roll their debt and at what rate they need to do that. And that is when you start to see an earnings compression. And earnings in Q1 was very robust. And so we have yet to see this really elevated cost of capital impact these companies from an earnings standpoint. And so until that time comes, we see Bitcoin, chopping around. At least I see Bitcoin chopping around pretty extensively. We're sort of in that limbo for firms where this elevated cost of capital is getting transmitted to them, but we're not at a point yet where they really start to feel pain. We're sort of in the beginning phases of that. And also, that being said, we're at a very great valuation level for Bitcoin right now. 20K is not only sort of your average, it's right above your average production cost for Bitcoin, but it's also right around several key levels, right? Your on-chain cost basis with realized price. It's also around the 200-week moving average, which is a really strong technical support level. So Bitcoin is viewed as cheap here, and people are really willing to buy it. So there's this phase of just extreme choppiness near the bottom, right? Basically where we are now, we've been ranging here because coins have been sort of distributing from weaker hands, people saying, I'm done with this, I don't want to hold this thing anymore, this thing is a stable coin, whatever, and it's shifting to those hands that are saying, I'm going to buy it here because it's really cheap. And also, not only is Bitcoin cheap at these levels, but also liquidity global liquidity is sort of rising at the margin, as measured by you take a look at the Treasury General account and the reverse repo facility, and also take that in confluence with what other central bank balance sheets are doing, what other central bank reserves are doing rather, and if their assets are rising on net, then that means global liquidity is rising on net. And so far, central bank balance sheets assets they were falling right all throughout last year, but beginning in February they were actually rising right all throughout the month of February. They were rising. And so should liquidity continue to be supported, and should Bitcoin continue to be catching a strong bid here, we're probably in for a whole lot of choppiness, right? If the economy is as robust as it seems, the Fed probably has the ability to hold rates very, very high. And if that's the case, there may not be very many upward catalysts for Bitcoin to sort of shoot through the stratosphere. By that same token, there aren't a great deal of downward catalysts as liquidity continues being supported globally. So that's really where Bitcoin stands, right? It stands in limbo right now. And of course, things can change on a dime, right? If global liquidity conditions begin deteriorating, Bitcoin will, in all likelihood, follow them down. If for whatever reason there's a credit event in the real economy, and the Fed chooses to ease, which the Fed easing at this point is, a bygone memory. That was the narrative all throughout 2022. And it seems to not be the case whatsoever. Their conviction has been tested several times, and they're going to hold policy tight. But if they end up not doing that, then that would obviously be a boon for Bitcoin. But outlook for Bitcoin is just a whole lot of choppiness right throughout 2023.
Yeah, I think I'm mainly in the same boat there. Do you guys ever look at M2 as like a gauge for liquidity? I looked at it the other day and I saw like M2 year-over-year growth was like negative. So I guess the money supply or the broad money supply was actually shrinking, and it wasn't at this low of a level since the Great Depression. Is that just like coincidence, or is that something to be concerned about?
My view on M2 as an accurate gauge for the money supply has changed somewhat. The reason being, for a while, like obviously any gauge of the money supply is just going to be incorrect. There's no way to measure these things accurately and take signal from them. But
Real
M2
quick,
is sort of seen as, yeah.
Except for Bitcoin, right? With Bitcoin full node, we know exactly how much Bitcoin there is and how much there ever will be.
Yes, exactly. Asterisk.
Explain the difference.
There's never any way to know how many US dollars or any other fiat are in existence because you have to trust. But with Bitcoin, you can verify, right? Run your own full node. You can verify the amount of Bitcoin in existence. And that's a beautiful thing, right? There's no accurate measure of fiat money. If you run a Bitcoin full node, you know exactly how many Bitcoin will be issued and how many Bitcoin will be issued for the rest of time. That's a beautiful thing. That's why we do what we do. That's why I have this big neon sign behind me. So my view on M2 has changed when it comes to measuring dollar liquidity. And that's because Brent Johnson tweeted a few weeks ago, and he tweeted this after I had my discussion on my show with Michael Howell, who's sort of the world's foremost expert on global liquidity. And Michael Howell took the position that it really, central bank balance sheets, central bank assets mattered far more as a gauge for liquidity than something like M2 or any of these money stock measures. And what Brent Johnson also said was that M2 is really just a function of the demand for M0, which is, base money. And so, thinking about it that way and understanding, okay, M2 may not be the most accurate representation, but then also, myself going into the Bloomberg terminal and wanting to validate what Michael Howell was saying, me going in, adding up, central bank assets together, taking into account the Treasury General account, the reverse repo facility, and it tracks basically 1-to-1 with risk assets, and it's really remarkable, right? As this better proxy for global liquidity is rising, rather than these measures for M2 that we have, risk assets rise in price, and I use the S&P 500 sort of as my very liquid example of that, and vice versa. And M2 does work, right? As a measure, I've made this chart several times in the past, but global M2, as that rises, Bitcoin rises. As that falls, Bitcoin falls. But in a period like this, it seems that central banks are getting into the practice of trying to stabilize their government bond market after the scare that we had last September, where the gilt market sold off so quickly and so fast that it threatened the solvency of pension funds who were basically collateralizing their assets against them. Then government, it was basically, the shot heard around the world. It was a warning shot saying, hey, don't let your sovereign bond market go illiquid because this thing is used as collateral for all of global finance. And particularly the U.S. Treasury market is used as collateral for all of global finance. And so central banks around the world, particularly the U.S., and this is Michael Howell's assumption, and now it's increasingly my assumption, that they've been taking a much more active role in managing the liquidity in their bond markets so that there isn't something like the gilt crisis like we saw last September. And because of that, what happens when you're more actively intervening in your bond market? You're purchasing these government assets, liquidity is rising at the margin. And so even though M2, is still deeply negative, you still have central bank assets that for whatever reason, and we're speculating that it's because they're supporting their bond market, is rising. And so as long as liquidity is rising, then, asset prices will be supported. If that changes, then it's a whole nother story.
Yeah, it was a really interesting perspective. I need to go back and watch that interview that you did. This is probably a great spot to end it. Where can people go watch that podcast that you were talking about and, learn more about you and what you guys are doing at the Bitcoin layer?
Absolutely. So you could just search the Bitcoin layer on YouTube, right in the search bar above this video right now. Or you could go to thebitcoinlayer.com where you'll be able to subscribe to our YouTube channel as well as our newsletter. Every single week, we put out 3 pieces of content covering Bitcoin through a global macro lens. We're relatively valuable if you want to keep up with what's going on in markets and follow them accurately. So you can go to thebitcoinlayer.com, subscribe to our Substack, but also subscribe to our YouTube channel where you can catch all those interesting interviews that I just discussed. And also find myself on Twitter at Joe Consorti for more regular markets commentary.
Awesome. Yeah, everyone go check that out. I pretty much read every single newsletter you guys put out. I think it's one of the best in the space for macro and Bitcoin. So great job there. But yeah, everyone go check that out. Joe, thanks again for coming on. This was a great episode. I'm sure everyone's going to love it.
Likewise. Thanks, Joe. Appreciate it, man.